All right, good morning, everybody. Gonna be a continue to hurry up and wait through this short week with everybody looking for reasons that we should go down. Another brick in the wall of worry, as if we don't have enough of them. The big event in Vegas started off with NVIDIA CEO. They're not going to be the only ones, though. I think we're going to continue to see a lot of software and tech names this week, get a lot of data out of them. Fed officials out chipping their teeth, Lisa Cook being one of the most prominent to cry wolf. Markets really ignored her, but we'll see how that goes for the rest of the week. Markets are up. Got a lot of strange events going on with Canada too. I know it might seem far away and that it doesn't really have much to do with us, but everything's connected, right? So you want to keep your eye on the dollar, bonds, yields. We've got job openings, which gives us a little bit of the jobs data, but it's not non-farm payrolls. Remember, the Fed has claimed victory over inflation. They're spending more time and effort now focused on employment. So anything connected to employment, you want to pay particular attention to. We got ISM services, and we've got a Fed speaker barking out, chipping his teeth. We do have an auction today at 1 o'clock. Remember, if we have an auction anywhere, if it's at 11, 11:30, or 1, just assume that those other two time frames also have auctions. Once we're done with jolts, the auctions are the last thing we have on the table for the day, other than any event-based news that may just pop up and hit us. All right, we still got VIX low in the front end. US dollar Japan retested that 158.5 area, rejected. So it's staying contained. The dollar is contained. It's back inside its range around that 108 area. We really want to see it get below 108 substantially. Right now, we don't want quick, fast moves in the dollar in any direction, but we do want to continue to see it fade below that 108. So it's down in that area. It just needs to get below that now and continue to ease lower out of this zone. And you can see sort of the tail end here right before Christmas where we were touching around that 107.5 area. That's the zone, 107.5 to 108. We got to get below this, really get an expansion below it. S&P and the NASDAQ back above the 10-day, back above the 3-day. That's a 310 surge play. And this morning, 3 got back above the 10. So first price gets through both. Then the 3 crosses above the 10. Now we just need to break that high and continue higher. So above 21.9 on the NQ and above 60.70 on the ES. that'll set us up for the next high that we have to challenge, 22.1 and 6,100. So you can see with the dollar here, it's a little easier to see. It's got to get below that 108, at 107.5. This level right here needs to break. That way we start setting lower lows to go with these, hopefully, lower highs. And the 10-year pressing against the high here, we need this going in the other direction. We don't want the 10-year rising up, especially if we've got any chance of the ES rising up or the NASDAQ. The concern is that sort of base move right there between the dollar and the ES. If these form that sort of cradle formation together, then hopefully we get this going to the downside. Otherwise, we get a breakout in the 10-year. We got a rising dollar. We got a rising ES. That's no bueno. All right, we got the call wall in our face this morning, 60.50. It's a big options level that we got to fight through anyways. So if we're looking at an inside day breakout, getting through yesterday's regular trading session, just the RTH low, which is at the 10-day, or the RTH high, which is at today's ADR half. To get there, we've got to get through that call wall. We've got 60.32 cog line. Underneath this, we've got 60.11 cog line. We're flirting with the volatility trigger, 0 gamma, and below that, somewhere down below, we got the put wall. 59.50. This green line is the 20-day moving average. It's what we're fighting against right now. The 10-day is what is supporting us. It's what supported us yesterday too. This is the cumulative volume index. When it's moving higher, we say we have net buying volume. When it's moving lower, we have net selling volume. It doesn't matter what name I have up here. It's looking at the NASDAQ. And it's not the NASDAQ 100. It's the full big NASDAQ, right? NASDAQ composite. I'm on a weekly chart, and you can see how we were like in this really tight squeeze, and then we started to expand out of it. We've been pressing against the upper edge of the Bollinger. We've broke out of that Bollinger band, and we're just riding it, expanding, pushing that Bollinger higher and wider. And it's pointed straight up. This is a representation of the market itself. So if you go look at NASDAQ, the S&P, that's what you would expect to see. They should match. They don't, right? We don't have all-time highs or even new highs on the year in the S&P and the NASDAQ. Now put it on a daily, and it's still at highs. It turned over a little bit yesterday, but it's still at highs. So net buying continues. All the talk about the bricks and the wall of worry, all the concern, and there's a lot of bricks. We've still got net buying coming in, and it's still really strong. Options flows are solid. The same Mag 7 names that have been lit continue to get lit. It's not done yet. So while we've got a lot of divergent signals and reasons for concern, we still have net buying. We stopped moving up yesterday when we hit the ADR half, by the way. If you're wondering what we hit and why we quit going up, we hit the ADR half. Surprise. Today, we don't have much edge on which side we'll hit first, or if we will even hit either one at all. To hit the downside ADR, we have to break out of yesterday's regular trading hours low. We have to get below 6,000 and the COG line at 59.92 to hit this lower ADR. Now, don't get me wrong, we can do that. Price can do whatever it wants. But that's a lot of things to go through. That's a lot of support down there. The 6011 COG line, yesterday's regular trading hours low, 6,000 option level, 59.92 COG line, and then we can get to this ADR half. But we got to get through all those structures first to get there. On the other hand, for a move to the upside, the ADR high is inside yesterday's range. We don't have to get an inside day breakout just to get to it. There is some resistance in there, levels that we have to work through, like the halfback, 60.36, the COG line, 60.32, the regular trading hours open, also the COG line, 60.32. Gotta love how these names and these pivots just line up on top of each other over and over. So if we can get through yesterday's open, the COG line at 32, the halfback at 36, we have a chance to get up to the halfback or the ADR half at 60.67. If we can get through that, then we've got yesterday's high, 60.68. We're back above the weekly floor pivot, which we were below all week last week. This week we started above it. We're still holding above it. And we have an MDP from yesterday. It's a missed daily pivot. So that daily pivot, it's tucked inside of this weekly pivot. They were both right there yesterday. We didn't hit it. So that's an MDP, and it counts for today. It was formed yesterday. It counts for today. We don't have an MDP today because we've already hit the floor pivot multiple times. Today's pivot is higher than yesterday's. That's bullish. Price opened above it. That's bullish. We got below it, but now we're back above it. We need to keep it. It's a narrow channel, which implies if we do break out, it could really grow legs and we could expand quickly. The problem is to, quote, really break out, we would have to run all the way up to this 60, let's just round it and call it 60.70. We got to get all the way up there, break out, and then continue to expand beyond that. To break down, we would have to get all the way down to 59.80, and then below that, through the weekly pivot to expand lower. It's very likely we get a sideways day today. Markets are waiting on data. We've got a short week. So a continued grind higher in equities while the S&P and NASDAQ just hold the line without really expanding much up or down wouldn't be out of line. I don't think it's going to be a sideways day, but it absolutely could be. The average daily range has increased more than 1/4%. Remember when this was 0.89, then it started to increase. It was at 0.96. Then we had the holidays and everything, and now we're at 1.29%. That equates to $78 or 78 points from where we open at 6 o'clock, higher or lower. $59.32 cog line is last week's point of control. Our current point of control is really in line with the point of control from 2 weeks ago. Just got a lot of structure here, and they're just overlapping each other. If we can get through this short week, which was the Christmas week, and we can get above 6,100, we've got multiple points of control back here, 61.32, and that's still the FOMC liquidity gap that needs to get closed. Otherwise, we're just holding within this structure. 5,800 up to 6,200. It's that 400-point range. It's likely we've run a whole quarter in this level. Got to have a reason to get out of it. The current options levels for OPEX, right? OPEX is the third Friday of the month, so next week on the 17th. I'll have to share the post. There was an options tool, kind of like Spot Gamma, that identified some key levels in the options land that if we continue to go to the upside, that would be our resistance in the SPX, and to the downside where we would find supportive structure. And that will last until next week. So potential for iron condors or some butterflies along the edges. And it would not hurt to carry some really cheap lottos for some outsized moves. All right, once we get through the Carter event this week, next week, we've got a lot of things that can cause volatility, could cause some outlier moves. It wouldn't hurt carrying some lottos for OPEX. $10-day, 30-minute volume profile, TPO and point of control on the volume profile, they both line up. This range isn't going to change anytime soon. And it's unlikely that we're going to see a shift in the point of control, especially since we're laying out new volume now. So even as we start to lose more candles from the left, say into Friday afternoon, Monday and Tuesday, we will wipe out all of those candles back there. We still have all of these here, and then all of the ones that we've been building in this new week. So at this point of control, where it is currently, is likely where it's going to stay for at least a week. It can move. We just have to land on an iceberg somewhere and fill it out, or hit a ceiling with some real liquidity against it to build out one of these other levels. So 59.70 or 59.85, this lower level has the potential to become the new point of control, or 6,100 if we can get up there and add to what we have from this little bit. Otherwise, we're not expecting to see that change for at least a week. The VPOC from the second was taken out, so we're done with that. We don't have one for Friday or from yesterday because we would have already hit them. So we've still got some overhead to deal with, but they're a long ways off and not really a concern at the moment. All right, we're back above the 10-week, and we're looking for this slope to continue. We've just started to move to the upside. We want to see a nice, smooth transition and continuation and expansion farther away from that 10-week. Now, there is a history or a precedent of getting near it and then getting stuck around it where we just cross back and forth above it and below it, right? So even though we're starting to work our way up, we can stall out and get back down below it. It's going to act like a gravity, and we've got to break that gravity and get away from it. It's hard to get a melt up away from the 10-week. Right now, you can get a melt up into the 10-week when we've overshot it and we're underneath it, and we're trying to get back to it. But once you're in that zone or around it, we need some catalyst to get us away from that 10. Looking at the 10-day, we're back above it, a little more than 1/4%. Just like with the 10-week, the range that we've been expanding above and below the 10 has really been reduced. You can see there was some highs, but it's been getting lower and lower. So think of it like a pendulum swing, right? Like a clock that tick-tocks back and forth with that little spoon underneath it. If it's mechanized, it'll continue to swing equally in both directions. But if you do it manually, just flick it to one side. So each time it swings back and forth, the swing is going to get lower and lower and lower and lower. And we can see the same thing in the blue line, where it's been trending lower and lower. It has been peaking as high. We need a new catalyst or a new outlier. And really, it's been a while since we've had a real flash move that galvanized the markets. The one that really comes to mind is August, right? When we had that whole carry trade unwind situation, Japan raised rates and the market threw a fit and the VIX spiked to like 65. That's the last real big market shaking event. We need a new one. Get us out of this range that we've been cooking in. We've got QRA coming up, so that can do it. We've got a new FOMC, the inauguration, government funding, the Canada situation, the South Korea situation. We got a lot of potential. Which one is it going to be? The week's expected move, we've already tagged it. We did it yesterday. So we made it all the way to the edge of the week, the entire week expected move. We're supposed to or expected to close inside of this range by the end of the week. If we compare the distance of this range to last week, you can see that they're really close together. This week has perhaps a little more volatility in it, not by much. All right, so this is the SPX. We could use the ES. It wouldn't really matter, but we're going to use the SPX. This is the concern that we've got, that we've had, and that I continue to point out for everybody who keeps asking me what I think we're going to do next. Man, I can guess as much as anybody else, right? And we can back that up with yields and dollar and looking at what's going on around the world. But if you're just going to use price action, this high is the concern, and that low is the concern. It's just pure price action. We've set a top and we've started to fall, and this is moving to the downside. So when we set this low, we needed to stay above it, or we would have a new low, a lower low. Now, equal lows and lower lows are two entirely different things. But this high up here, depending on what happens today, if we fall away from this, we're going to have another lower high. That's two lower highs, and then we would have a low here. We've only got one low. If this is lower, that's only one lower low, right? Because there's a higher low, higher low. That's a lower low. We need two. Two lower highs, two lower lows is a full set, and a full set is a trend. And that would be us trending to the downside. We went lower than that low, 58.32, and we went underneath it. Not by much, but it doesn't matter how much. We went underneath it. So right now, this move to the upside is what matters, and whether or not we can get through this high. If we can't, and we begin to roll over and come back down, say we close this gap from Friday, moving down just that much would set this as a lower high. Now, I use trend candles. It just means that whether or not they're hollow depends on how they closed versus how they opened. So this solid blue candle means that we opened and then fell, and we closed lower than where we opened. It's still blue because we closed higher than the previous day's close. So we did close higher than yesterday, but it opened, it tried to rally, and then it fell, and it closed lower than it opened. So it's solid blue. This hollow red means it opened, and then it ran up, and it closed higher than it opened. It's still red, though, because it closed lower than the previous day's close. So we got some gaps below that we need to deal with. We closed Friday right there, and we opened Monday up here. But we also closed down here, and we opened here. So this is a gap that needs closed, and this is a gap that needs closed. We've got a gap up here, because we closed here, and we opened it down here. So we've got gaps all over the place. We've got resistance levels that need to be taken out. We've got another gap up here, by the way. So we closed here, and we opened it down here. And we still haven't made it back to that one either. And then there's the liquidity gap from the FOMC event, which we can't see on this time frame, but there is that liquidity gap from FOMC too. The point we need to get through is 60.50 on the SPX. It's this high from this day here, from the day after Christmas. So on this current drive to the upside, it's like a swing low, and we're on our way to the upside. We have to get through this high, because if we start to fall, it's going to be a lower high. And that's going to complete the topping pattern, and then we'll be looking to break this low with some new lows. China, nat gas, and Bitcoin are down this morning. To be fair, Bitcoin is still up 8.5% over a 5-day period. So sure, it's down a little bit this morning, but it was up almost 10%, and it's still up 8.5%. So yeah, a little bit of a pullback after a big run. China's down. Now this thing was down about 3%. Now it's down 5.25% over a 5-day period. So it's bleeding off a bit. And then nat gas. Nat gas has been making wild moves, and it's still making wild moves. Looking at the things that are up this morning, gold miners, chips, energy. Everything else is below our benchmark of 0.5%. Now, energy is vague because it has everything in it. You really want to flesh that out and see, is it crude, wind, solar, coal, uranium? What kind of energy is really driving this energy move? And we can see that gold is up, but we don't see silver in there. There's silver. That's a thinkorswim thing. All right, so we got gold, precious metals, silver. Airlines are still up. There was a little bit of news about their cancellations through this big storm. They're doing really good, all things considered. They've had cancellations, but it isn't big record-breaking numbers, right? They're not going to have the debacle of the last time, which if you were running plays in DAL or UAL, that was kind of the worry, right? Is that if you were looking for that flip, you see this absolutely amazing run. If you were looking for that short, it was based on something like the winter storm with some really bad news, or maybe a contagion threat. But the report that came out this morning on their cancellations and how bad it wasn't that bad. So you're going to need some other reason now. And then chips, NVIDIA kind of kicked everything off, but that event is still going. It's going to be going all week. There's been some quite a bit of talk about MU. So we'll see, how far that carries. But MU is up. It's just a part of the chips. All the chips are up. Well, not collectively, not all of them yet, but they're moving in the right direction. As long as we continue to have chips driving, keep your eye on things like IGV or the names that are in the IGV. This really doesn't move much pre-market. It's a slow ETF typically, but open this up. It's a basket of stocks. See those software names that are in there. We're wanting to avoid an either or situation, right? We don't want it to be software or chips. We want software and chips. And then looking at energy, we can see uranium kind of driving really close with crude. Solar is basically flat. So we're looking for that rising tide, that it expands beyond the Mag 7. It gets out of consumer discretionary technology financials, and it starts to spread into things like industrials, building materials, utilities, commodities. Right? We want that rising tide lifting all boats. It'll help with the slow grind in the S&P and the NASDAQ. So keep your eye on dollar and yields. Watch the VIX for any signs that this contango is going to flip. And keep your eye on the news. Other than that, be careful, be safe. I'll see y'all tomorrow.